Hey folks, Dan Frio here with your market update. So what we see today is the unemployment number is going up. And therefore the markets in a normal market should be crashing, but in this market, the markets love it. So what's really going on? So we see in the markets right now is everybody is focused in on inflation, and so is the Fed. So the Federal Reserve keeps driving up interest rates, and their hopes are to bring down inflation. But one big piece of this is it normally causes the unemployment rate to spike. Okay, that's what we're starting to see today, and the markets are loving it. So I'll put it in the context as we go through this video. So what you're seeing on your screen is what I see on a daily basis. It gives me the 10-year Treasury, the 30-year MBSs on the 5.0 coupon and the 5.5. None of that you guys need to really be concerned about because this is way too in-depth for you guys. So let me go over and make this make common sense for you. So what we have right now is in the news this week is Federal Chairman Powell is speaking in front of Congress, or he's done doing that now. And it shocked the markets on Monday and Tuesday, and then Wednesday things started settling a little bit, and then today the markets are starting to find some stability somewhere. So let's get into the news that we have right now. So today's number, the only thing that we see is the initial jobless claims. Now this is what I was saying. In a normal market, you want the economy to kind of clicking on all cylinders. And that, you put money in the stock market and you watch it, accumulate over time and build because we're investing in a solid economy, a solid market. Well, right now what happened is there was so much stimulus in the economy that it spiked inflation. I'm going to give you some inflation numbers here in a second that don't look really good even after what the Federal Reserve has been doing. So now what they're trying to do is they're trying to really focus in on the employment numbers, and they're trying to spike the unemployment numbers to put more people out of work. Okay, so this week in front of Congress, Federal Chairman Powell is sitting there and he's getting drilled by people. They're saying, okay, so you're increasing rates, it's making everything more costly, and now your really target is you're trying to drive up the unemployment rate. So you already kind of screwed up this market already. You're going to screw it up even more. But the Federal Reserve doesn't have to take all the credit for the screw up of the economy. The federal government also is involved with this, and they pumped out way too much stimulus. And I'm going to show you some of this analysis here in a second. So let's get over to the headline news. Like I said, the initial jobless claims, it's the only number that came in today. And look at the numbers on the screen. The previous number, there was 190,000 people filing for the first time that they got unemployed. Okay, the expectations were about 195,000 because they're expecting the unemployment numbers to go up because of the Federal Reserve's actions. Well, that number came in at 211,000. More than expected and much more than where we were in the previous reading. Now, a huge number coming out tomorrow is the federal government's numbers on non-farm payroll and the unemployment rate. You can see down below. The previous reading on the employment numbers was 517,000 new jobs. New jobs, that is nuts. That's an economy that basically just came out of pandemic mode. We've been out of the pandemic mode for what now, a year or two? So to have a reading of 517,000 spooked the markets. Just think about it. About 30 days ago, interest rates were 5.99. You're going to see we topped the 7% mark within the last week. Not good news, but I might have some good news on the horizon for you. So the next thing we want to go to is right here, significant drop for construction jobs. So what's happening is mortgage rates are spiking up, and it's causing a retraction in the housing business, and now we're seeing it in the construction jobs for new housing. So what's this going to do? I think it's a good news, and here's why. If you have less houses on the market, okay, it's going to cause at least some stability in housing that the markets don't really turn over and start to crash. Why you're not seeing a crash right now in a lot of areas, blanket across the whole country, is there's not a lot of inventory out there. For myself, let's take myself as an example. I would love to move. The rate on my home is 2.5%. And it's a fairly big house. So if I now sold that property and bought another property and I had to buy it 7%, my payment would be up about 50% just because of that. And I don't want a higher payment. So it's causing a lot of people to start saying, okay, I don't want to sell my house. And now you're starting to see where the new construction homes are starting to kind of taper back now. So it's going to put a cap on the amount of homes for sale. Thus, I'm pretty sure this is going to happen. It'll stabilize the prices. Yes, some areas are going to drop. Some areas will maybe stay stagnant. But this is going to help in the long run just for stability purposes in housing prices. Because think, the more supply you have, Well, it's going to drop the prices. So if you have limited supply with limited purchasers, then it's going to stagnate the market and kind of hold some stability or give us at least a threshold where we can't really plummet in values. So that's my thought on that part of it. The inflation numbers. Here's what's happened with the inflation numbers over the last couple years. You can go back to 2017. Look at what happened. It goes 2017, we were about 0 to 2% or a half. No, I'm sorry. Basically 0% for 2017, 18, 19, 20, and then what? Whoa, look at the increase in these prices. Now, this is what the Federal Reserve is contending against. So I also thought it was transitory back when everything was happening, because my thought was, well, the whole world's shut down. Okay, the whole world's shut down. Nobody's making anything. People still have jobs. But we're pent up in our homes. So we can't spend money, like I was saying in yesterday's video, we can't spend money on, casual things like going to the movies, going out for drinks, going out for dinner and everything else. So what do? We just start spending on goods. And that jacked up the prices, as you can see through here. So now what we're also seeing is people are coming out of their homes, and now the service sector is going like bonkers. I went out for my wife's birthday on on Tuesday. The places are packed, okay? And in yesterday's video, you probably saw that I showed you that consumer credit card debt is spiked to the highest levels ever in history. Something to be concerned about. So the next thing is we see, based on the information coming in right now, how's the markets faring? Well, the Dow Jones is up 66 points, 0.2%. You can see that its S&P 500 is up 7 ticks, not much, but it sure beats red. Okay, and then you see the VIX. VIX is basically, I watch the VIX because it shows me the volatility in the markets, and negative right now is good. I like that. And then you can see gold and oil. Look at oil. Here's another conundrum that I have. Oil prices, if we dig into this number, and this is a huge part of the inflation numbers, if you dig down in here, look at where oil prices are and where they're going. Okay, so here's a chart that we have over the last, let me go back to the last, let's just take a 3-year history. Okay, here's what it looks like. All right, so you remember back in these days right here, we hit gas, and I don't know about you guys, but in Illinois, it was about almost $6 a gallon, and then it went down. You see right here the stability in the last few months. So I asked myself, like today, I went past the gas station, and I know I'm beating the dead horse here. Yesterday on my way home, it was $3.33 at this gas station. Today it was $3.69. It went up 36 cents. Okay, that's 10%. How? The markets aren't moving. I think the oil companies are starting to gouge us like a lot of other companies right now. So based on all of this information, what in the world's going on with mortgage rates? Well, you're seeing on your screen right here. Here's what's going on. So what you're seeing on your screen right now is what's happening to the mortgage-backed security. It's a bond that trades on Wall Street. And I focus in on this. I don't focus in on the 10-year Treasury or the 2-year Treasury or anything like that. This bond is the bond that's relative to your mortgage rate. So what happens with this is the price of a bond. You can see it on your screen. What happens? Let me make sense of this for you. As this number goes up, mortgage rates come down. So we love when it's up. Do you see the last week or so? It's been down, down, and down, pushing rates back up to a higher level than we've seen in about a month or two. Okay, so let me explain how this works for you for the newbies out there. So as the price of a bond goes up, the yield goes down. Here's a perfect example of how this works. Let's say, for example, I buy a bond that's face value when I turn it in is $100. Okay, so let's say today I pay you $50. All right, so I give you $50 today. And next year, when the bond matures, you give me $100 back. What is my rate of return? It's 100%. I doubled my money. Okay, so let's raise the price, and I can show you how raising the price drops the yield. Okay, so let's make it simple. Let's say I give you $100 today, and next year when my coupon matures, you give me $100 back. What's my rate of return? I gave you 100, you gave me 100 back. 0. Okay, so you see, if we pay more for a bond, the yield comes down. So we like it when the yield is going up. We haven't seen much of that in a while. You can see the chart here. Look at the just steady decline since April of last year. So that's not good news. We're hitting rates that we haven't seen in a while, but let's go over to where rates are. So today, here's what you're seeing. These are the top 6 products people use when they're buying or refinancing a house. These are issued by Mortgage News Daily. If you want this, to subscribe to this, it's free. You can click down below. But if you want to subscribe to this and get this and more and more and more data, you can subscribe to my newsletter down below. It's free. I don't sell the data and I won't pester you, I promise. You can see right here, here's the 30-year fixed. Today's average throughout the whole country is 7.05 as obtained by Mortgage News Daily, right through here. So you can see that. Look at the 52-week high of where we were. 52-week high was at 7.37. So we're about 0.25% or 30 basis points off of where we were. But just 2-3 weeks ago, this rate was 5.99. So not a good market right now for mortgage rates. The stock market is really bubbly and it's all wrapped around what in the world is the Federal Reserve going to do? And that's what I'm going to try to keep you abreast of every day. So thanks for watching, guys. If you find these videos informative and you'd like to learn more, all I ask you to do is give me a thumbs up, subscribe down below, hit the bell. Every time I post a video, you get an alert. Thanks for watching, guys. God bless. I'll see you tomorrow. Bye-bye.